This is the Commercial Wealth. My mission is simple: to help you achieve financial freedom through commercial property using calculated risks and practical education. My name is Basha Deswani and I'm your host. Welcome to the show. Thank you so much for being here.
Thanks for having me, Basha.
Matt, we just want to know a little bit about your journey and your Lendsmart. How was that born?
Awesome.
And your journey in the business.
Happy to share. So I'm a finance broker. I specialize in commercial. I do resi as well, but commercial is definitely my passion. I've been with the NAB for over 15 years.
Oh, wow.
And that was a wonderful career, and NAB was really, really good to me. But I guess my career kind of got to a point where if I wanted to progress, I would need to specialize or change direction in the bank and say goodbye to all these amazing customers. And basically, I didn't want to do that. So I decided to start again and help borrowers find the right lenders. So I've got more scope than just the one bank, but also customers that I could basically be on the journey with them for as long as what they wanted me there. In the bank, when you work in different segments, you know, if you're a senior banker, you can't take small clients. If you're a junior banker and your client grows, they might outgrow you. They might need to go to another banker. And I was kind of just over that. So here I am working with people and part of their journey for as long as they need me.
Just helping them add value and then make the most of it, basically.
Absolutely, yeah.
No, thank you. Just behalf of my clients, because I know that you've helped them and you've gone above and beyond to help them. You are an amazing financier. So anyone looking, contact Matt Weber.
You're very
from
kind.
Lendsmart.
Thank you.
I had to plug that in. So just a very quick question. I think the first one and the most, the popular one is, for someone entering into commercial property for the first time, what's the biggest misconception when it comes to commercial versus residential? Commercial
has so much variability in comparison to residential. Residential is so tightly regulated and it is always looked at through a lens of full debt servicing position, amortizing that loan down. So even if you have an interest-only loan with residential, your lenders are going to base it off what's the term as if it was principal and interest to make sure that they're compliant with the regulations. Whereas commercial can be a lot more commercial. And when you're purchasing a commercial property, especially if it's for investment, lenders know that the ultimate clearance source of the debt is not going to come from the borrower paying it down gradually. They're usually the borrower's usually looking at a cash flow investment, and the ultimate clearance source is going to come from the sale of that asset in 10, 15 years or whatever. So they're happy to look at it on that, that the actual repayment basis, which might very well be interest only. But once again, there's so much variability and it changes all the time. Once upon a time, if you were looking at commercial property, it meant you're going to have to only borrow up to 65, 70%. And so you had to have that deposit. And while that 30%, still is the case, it still is the case a lot of the time. But there's a lot of lenders now, especially if you're looking for a commercial property for your business to operate out of, you might be able to borrow up to 80%. And so that's something that's changed a little bit more recently. And just, there's so much variability between lenders, between asset classes. I think, shameless plug here, but engaging a broker early and having a chat to a broker will really, really help you target what you need to, which lenders you can look at and which lenders are going to work for you.
Yeah, for sure. Like, as you suggested, because I've been burnt in the past of not being ready and not knowing the numbers, I had no clue what does even a fixed versus a variable rate mean, and what's the difference between the two, and how does it affect me in the long term. So if you don't have someone who is going to guide you in the right direction and who has got your back, then you're actually it's a waste of time, money, energy, and all of your structure is just down the drain, basically, and you have to redo everything, which is going to cost you, again, time, money, energy. So just having the right person is very, very important.
Absolutely.
Yeah, just on that note, fixed versus variable rate, what is the difference between the two, and which one is better than other, or what are the pros and the cons, and what should I do if I have no clue about finance?
Great. The answer to that question, just like any good question, the answer is it depends. So really quick rundown for people that might not be aware. Variable is where the rate will go up and down depending on what the projected rate is. Now, business lending can use a couple different ways of measuring what that base variable rate is. It might follow BBSY, or it might have its own metric built in from the bank, but it's not the same as your fixed rates on home loans. It's not the same as your variable rate on home loans. It tends to move a little bit more quickly and independently of the RBA.
Yeah.
Fixed rates, however, exactly what they are. They're fixed. You pick a time, you get that rate, and then you are locked in at that rate for a certain period of time, whether it be 1, 2, 3, 4, 5 years, or maybe even longer.
So you can't change in the middle of it?
No, you can't. You can break a fixed rate, but if you do, you might be up for economic costs. But also on the flip side, you might be up for economic benefits. It just depends on what the fixed rate is compared to what the going rate in the market is. So if you've got a very low fixed rate and you break that, and the bank can get more money for that money, then you might actually get an economic benefit. But at the same token, if you fixed in high and the current rates are very low, it's going to cost the bank money, and they will pass that on to you in the form of an economic cost.
For sure.
The other aspect of fixed rates is usually you don't get the benefit of making early repayments. There's no redraw. But I guess when I'm talking to clients about, which one's best for you, if you are trying to set up a portfolio and you've got a strategy and you want to know exactly how much your expenses are going to be month on month for that set period of time, then fixed is a fantastic option. But if you're looking at fixed because the fixed rate seems quite low and you're trying to play the game of beat the bank, you're probably going to be a little bit disappointed over the term of that loan, because there's generally people out there that are a bit smarter than me anyway at working out what a good fixed rate should be. And outside of a few select scenarios, you're generally not going to come off any better. But if you're quite happy to ride the ups and downs, and your budget has the free cash flow to do that, and you're likely to be able to make additional repayments here and there, then variable might be a better option.
Right, okay. So in terms of variable, which means that it will give you the flexibility to pay principal and interest, and then if you are going through a bit of a tight cash flow, then you can just pay the interest. Is that the right understanding on that? Or
generally, it's really easy. If you're on an interest-only loan and you're on a variable, you can make additional principal repayments. But if you're on principal and interest, then all of a sudden you want to go on to interest only, that would generally be a reassessment of that loan arrangement.
Okay. Yeah. So you'll have to go back and reassess and then
more
do
paperwork.
it all again. Yeah. The fun part.
Yeah, sure.
What is the smartest way to structure finance for cash flow positive commercial assets?
The best way is a very, very individual thing. And this is where it's so important to get your advisors lined up really early in the process. One of the first people you should be speaking to is your accountant. There's a bunch of different ways that you can do it. You can purchase it in your own name, you can purchase it in a company, or you can purchase it in a trust. Each one has its own pros and cons. And if you're talking about a cash flow positive investment here, there's tax implications. The other aspect of it will be, capital gains. What is your overall strategy? So really important, have a chat to your accountant. Ask them, hopefully you've had an accountant for a while and they understand your scenario. Ask them how you should be purchasing it, but also ask them why. Why does the accountant recommend that entity? It is important for you as the borrower to understand why you've selected that structure and also the pros and cons of that structure. So I won't go into more detail than that, because then I'll have to give a disclaimer and then it'll be all sorts of trouble, right?
So if something goes wrong, it's usually the accountant hasn't structured it really well, and you as a client needs to understand why and how it needs to be structured. Otherwise, that time is again wasted and that money is wasted, and you have to, financier might just say, no, this is not the right structure for it. So you need to go to the accountant to do a whole new structure, but you'll have to talk to your accountant because I'm not the accountant. And then you go to the right accountant and then they will do it all over again, which is going to cost you time, money and energy. So finding, again, we're coming back to that, which is like finding the right people is very, very crucial in the game. And I have learned it like by bad experiences. I've actually now I feel like I've found the team, and for us doing this podcast is basically trying to sort of guide you in the right direction so you have that team already and you don't need to sort of go through the bad experiences that I'm sure you would have gone through a lot of bad experiences as well. So yeah, just contact us.
Yeah, that's right. And having the right team does actually help in the lending process. When I'm writing a credit submission to a bank, if the client does have a buyer's agent, an accountant, project manager, if it's a development, I will include who that management team is, so the lender can see this guy's getting the right advice. Like they might not know everything themselves.
So that's a big tick.
That's a big tick. Just on the topic as well, like the accountants and the structures and things like that. Land tax is a big one. I've seen some big assets purchased with 4 trusts. And while that costs a bit of money to set up 4 trusts just to purchase this entity, it paid for itself within the first year just on savings in land tax. So, there can be implications in land tax, capital gains, tax from the income if you don't have it set up in the right entity for you and what you're trying to achieve. And then there's asset protection as well that should come into that.
Yeah, for sure. Thank you.
Too big a topic for this podcast today, Varsha.
Well, everything has got so much depth into it. Every question that you can just go on and on forever.
Exactly. Yeah. I'll try and be brief. I can talk the leg off a chair, but I'll try and keep it as succinct as possible today.
How do finances actually define in like risk in commercial property assets? Like what are the tools that you define risk in commercial?
There's a heap of risks. When I was cutting my teeth in the bank, they always said, we're not in the business of money, Matt, we're in the business of risk and managing it. So you've got tenancy risk. How strong is the tenant? Have we got, a little bakery, independently owned bakery, or have we got an ASX listed tenant in here? What about the lease? Have we got lease risk? Are there conditions in the lease that are that have disadvantages? Is the lease short term? Is the tenant likely to renew at the end of that term? You've also got asset risk itself. So you'll probably hear me talk about light industry a lot today. It is my favorite. It is an amazing asset class. So, you compare a light industry where you could have, any wide range of small businesses or medium-sized businesses, operate from there, and compare it to something like maybe cold storage. What is a cold storage asset good for? Cold storage. That's it. Childcare, that kind of thing. So asset class risk as well. You've also got borrower risk and management risk. If you're looking at maybe something that's a multi-use, multi-tenanted commercial building, and you've got somebody who's looking to buy it that doesn't plan on getting a property manager in there and they've never managed a facility like that before, there could be some issues there. I'm sure I've missed a heap. There's industry risk as well. There's environmental risk, social risk, governance risk.
So there's just quite a lot that goes into it before we sort of even move forward.
That's right. And this is why we talk about getting your team set up nice and early. Do you really want to spend the time to learn and understand every little angle that a bank or a lender might look at something from? Or do you want to engage somebody who lives and breathes it and they can give you the highlight reel and you can just focus on what's important?
100%. We will all come to you. What makes a borrower truly bankable when it comes to commercial property regardless of their net worth?
Having their financials in order is a big help.
One.
A big one, right? Yeah, I love that conversation. Hey, I want to do this, but I haven't done my financials for 3 years, and the accountant's hasn't even started it yet. So that's I wouldn't say an early warning sign, but probably an early warning sign that this isn't going to be a quick and easy process. Understanding what structure you're going to purchase in and why. You don't necessarily need to have that entity set up, because we can spin up a company or a trust in a few days. Not we, your accountant can. But understanding what you're going to do, bankable, your experience, and knowing what you're actually purchasing. So, you can come in and say, I want to purchase a commercial property because I went to a barbecue and somebody said it was a good idea. And, well, what do you mean by commercial property? Are we talking about light industry? Are we talking about childcare, cold storage, office space? Are you looking for capital growth or are you looking for cash flow? Once again, that's going to depend. So understanding what you're looking for and how to get it is
the first step.
Yeah, absolutely.
Yeah. Because there's just so many types. And coming back to it, like, what is the best type of commercial property that you should invest in order to get like it's like a set and forget. So you can't go wrong with it, basically, if you're someone who's just starting the journey in commercial.
Look, I'm going to say light industry.
I already knew that answer.
Yeah, of course. Light industry is great. Especially if you've got a long-term tenant or a long lease with a solid tenant in there that pays on time and doesn't give any trouble. One of the big concerns about commercial, and rightly so, is vacancy risk. But if you've got an asset that a wide variety of businesses can move into, it's suitable, it's accessible.
Like retail?
Retail can be. Retail can be. The only reason I hesitate when I say retail is retail's a tough game.
It is.
So your vacancy risk might not be as high, but your tenant risk is probably a little bit higher because what would you say is a more solid and stable business, a small scale manufacturer that's been trading for 20 years or a cafe that's just a startup. And I know I'm using extremes of either end there, but retail does have a different set of risks, even if you look at it from a vacancy risk perspective. But, in saying that, I say hospitality and retail is a tough game, but hey, there's some amazing operators out there. So look at your tenant closely.
Okay. Look at the numbers, look like how much experience they have and how successful they have been.
Yeah. Absolutely.
How do lenders assess specialized assets such as medical, childcare, or mixed-use properties?
So how do they assess? Look, secondary use is something I touched on a little bit before. And if you're talking specialized, the secondary use is not as wide. The vacancy risk is a bit higher, so there's a bit more emphasis on how good is the tenant, how good is the lease. A big difference between those more specialised asset classes is going to be the loan-to-value ratio that a lender is prepared to go up to. So if I'm looking at a light industry, owner-occupied, a lender might lend up to 80%, which means you only need to put 20% in plus your costs. But if we're looking at something
even in off the plan, for example, if it's a new build and if it's an industrial new build, like new build sheds, how much deposit do you need do you still
It depends.
need the same?
It depends from lender to lender, but generally, if you're looking to operate your business from that site, a lot of lenders will go up to 80%. If you're looking at that as purely as an investment, a lender might look at it maybe 70-75%.
Right. Okay. So depending what you're looking for.
Yeah. And the main reason for that is if I'm a lender and you're going to run your business from it, I can say, hey, Varsha, let me have a look at your financials. I want to see how robust your business is. I want to make sure that you're not going to go broke and, not be able to pay this.
To pay.
Yeah. But if you go, hey, Mr. Lender, can you fund this asset? And here's the tenant. I can't knock on the tenant's door and say, hey, Mr. Tenant, can you give me the financials? True. I've got no right to look at that. So I need to make assumptions based off industry, based off a quick little Google search of the business and a bit of an understanding of the history of that tenant. But it's a lot more guesswork. So the bank's going to want a little bit more margin for error in there because a commercial asset that is empty with no tenant and struggling to get a tenant is not much of an asset. And if you need to sell it on vacant possession, you're not going to be able to get a great price for it.
Right.
Yeah. So there's a bit more risk
so
there.
they would. So if, for example, if it's a new build and then that you are, because of the high demand in that industry, you will be able to lease it and it's in a really good suburb as well, then you need to see the comparable properties that have been leased in the past couple of months in order to see whether it is it is viable or not. Is that right? Or
So are you talking about sort of market value of the asset?
so
or?
how do you, as a financier, how do you back it up and say no? It will be leased in a couple of months. It's not something that will be
absolutely.
vacant for like 2 years, because in commercial there are properties that will stay longer on the market and it's not leased. So for people who actually have to pay the repayments, it's really difficult. And for people who don't have to pay any repayments, it's fine for them, but it's still causing them like a lot of loss. But how do you back it up by saying no, it will be?
Lenders put a lot of faith in valuers when it comes to this kind of thing. So we do know that something like a light industry is going to have lower vacancy risks than a cold storage. But every time a valuer does a valuation on a commercial property, they'll usually have a section in the valuation that gives us an indication of how long we can reasonably expect a property to be relet or sold. You know, anything that's sort of 0 to 3 months is great, 3 to 6 months is also good. But if you've got a challenging asset class, they might say, hey, this is going to spend an extended period of time. And so we need to make sure that the other risk factors of that asset class and that transaction are quite robust to mitigate the risk of the vacancy or tenancy risk that we're talking about there.
Okay. So if someone who is a real estate agent, for example, and they are really new, they have just completed their course and they want to build their property portfolio, commercial property portfolio, what are the couple of things that you would ask them to do it before you even step into that game, which will be like in 3 to 4 months or 6 months? What would you need to prepare as a buyer or as an investor in order for you to sort of move forward in the right direction of building portfolio?
Understand your strategy, understand your structures that you're going to use as well. Your growth might actually have, your strategy might be, the first asset is something that's going to give you a bit of capital growth in a short period of time so that you can leverage off that to purchase the next one. And then your issue beyond that might be servicing. So asset number 2 might actually be a positively geared cash flow asset that doesn't have quite as much capital growth into it. Oh gosh.
So saving on the costs, and then because if you are someone who is just starting their journey, making sure you're not spending money on like stupid things and you actually put money into that is going to grow in the future, basically.
Yeah, that's a really good point. With commercial property, often you do need a little bit more money up front, so there might be a bit of discipline involved in terms of your finances, but also, once you've got a good lease in place, they're usually really good, and you don't need to invest in them because the tenant will typically do that. But also, depending on what asset class you're looking at, if you do have a vacancy, you might actually need to offer 3 to 6 months free rent to attract a tenant. You might need to contribute to an expensive fit out to attract a tenant. So having your cash flow reserves is important as well. Yeah.
So making sure you like earn and there is enough cash flow initially. In like 1 or 2 years, you just need to focus on having income. Then you can buy it, and then making sure that you are disciplined enough to save money and not get sort of in the game of, because my friend is doing that, I might do that too. And just saving money, it is so hard. Honestly, it is really hard. So just saving that and then moving forward step by step from there. And then when you are actually investing money and growing your portfolio, your friends are not doing that. You sort of lose that friend maybe, and that's fine. Yeah. Because you sort of look at, no, I'm growing my future. And whatever it is, like I'm moving in the right path. So you have to be very, very determined.
Yeah. I remember a friend telling me a long time ago, I don't know where he heard it, but it's always stuck with me. And he was saying, if how you measure success, however that looks, it might be financial, it might not. But if in your circle, you are the most successful, you need a new circle.
You're not in the right.
You're right. Because other people, you're lifting others up. You want to be in the circle where you're actually at the bottom and you're learning and you're growing through those friendships and those relationships. So that ties into a little bit what you said there. Yeah,
100%. So you always have to, and that happens quite a lot as you grow. And if you are someone who is like constantly growing, you will keep on changing that room every time. Yeah. And if you find it like really hard and know it's just out of my comfort zone, I'm going to lose my friend or whatever. But if your friend is not growing, then it's not healthy for you in terms of the growth. I don't know. I just look at it in that way. And then it's just going in a bit of a motivational side. But I love having those conversations because I did not had someone to sort of rely on and see like, oh, wish I had that person that I can rely on. I just was intrinsically motivated enough to sort of move in that direction because I think growing up, I saw my dad doing it and my dad did not have a lot of friends. And I was just looking at him like, when I got married and I saw it's on a different topic, but I saw my ex like having a lot of friends and that was very new to me because I come from a family where it's like I'm with a family man. Like my dad is a family man and he would just give more than enough time to family and would not have any friends and just nurture and nourish them compared to having a lot of friends and just, like having the fun of it and not sort of, I'm not saying not to live your life, but having the right people around you is so, so, so important when it comes to people, like quality versus quantity any freaking day. And
100%.
Yes, you will lose friends, but that's the journey.
It is okay to outgrow people, and that doesn't mean that that person is not a good person. It just means that you are you're in different directions. And you said before something about relying on those networks. It's not even necessarily relying on them, but more so to be motivated and uplifted by them. And when you catch up with them and you see that they've done this and this, and that inspires you to dig a little bit deeper and try a little bit harder. Like that's a valuable friendship.
Yeah, 100%. Sometimes when I feel like, I don't want to, like when you're doing the same thing again and again, you sometimes feel like, what am I doing with my life? Or like I reach out to a point, I'm like, I don't want to do this anymore. And then you feel a little bit demotivated that day. And it's okay to feel that. There are days when you feel like very unmotivated and you feel like I don't want to do it anymore. I think that's when you meet, like this happened to me just this morning. And I met a group of friends and it was just like, we all are business owners and we all were talking about like growth and what was actually, what are the things that we don't like and we want to change in this year and what would be that one thing. And it keep on getting back to that one thing was just like knowing where you want to go and having that clarity is so important. And if you're just doing it for the sake of doing it, of course, you are going to get like burnt out at a stage and you will feel like, why am I doing this? But having that clarity and having that like, I want quality, not just quantity. And then now when I've come back from that, I feel like so much energy and you just feel like your cup is filled without even doing like starting your day on the normal things that you do, but you've actually learned so much and that energizes you and keeps you going, I guess. So sorry, I don't know why
you don't need to apologize.
talking about that, but
I caught up with somebody and they asked how things are going and I was pouring out my heart in terms of all the challenges and stuff that I was facing, and they patiently listened to me for a little while. And then when I'd run out of steam and stopped talking, they said, wow, what are you doing about it? And I was like, oh my God, you are the best friend ever. That is exactly what I needed to hear. And so the whole drive back home in my head, I was thinking, well, what am I doing about it? What am I going to do about it? What can I do that I will do that will make this better? And it was just the best.
Oh, that's awesome. Okay, coming back to why should investors consider non-bank or private lenders instead of the major banks?
Probably flexibility is one. This really, really comes to light in development funding where we're building a commercial property or a commercial facility. The banks, the big four banks, they have the name, they have people coming to them. So they have the privileged position of being able to be a little bit more risk averse. Like if you've got more transactions coming to you than you can possibly process, why would you take the riskier transaction with the lower profit margins? So they sort of pick and choose what they do. So if you meet the bank's criteria for what a good borrower looks like, well, yeah, great. And the benefit is that you will get great pricing. But if you've got other challenges within your scenario that doesn't quite fit within that mold, and you want a little bit more flexibility to do different things, especially in development, then a second tier lender is going to give you the flexibility and the faster funds, but you are going to pay a bit of a premium for it. And then the same thing happens again when you move into private funding. So this really comes to light in development funding because the major banks do less than 7% of commercial developments in this country, and
Crazy.
the big thing that they want is pre-sales or pre-leases to get that debt coverage. Now, developers don't want to do that because you can get a better lease or a better sale for a finished product than you can with a pre-sale or a pre-lease. But the lenders want to know that their primary exit is sound and safe, so it protects them.
That's why they do more resi. Is that right?
Yeah, absolutely. Yeah. The big banks are all over resi. Once again, there's less variables.
Yeah.
There's a lot less variables in there. Something simple like if you're doing a resi development with a banker, valuer will go out when the slab is laid and before the final payment is made, and that's it. Whereas if you're doing a commercial development, you'll have a quantity surveyor that will go out every time the builder issues an invoice and says, "Hey, it's time to pay me," and they will make sure that the builder is not claiming more than what they should. A lot more variability.
Yes.
A lot more risks as well. Yeah.
On that note, I've got a question on the industrial and medical development. So what does a lender look for first when they are assessing an industrial or a medical development deal in Queensland? Is it the site, is it the FISO, or is it the developer, or is it all three?
It's all of them. And so if you've done a couple resi splitter blocks and then all of a sudden you want to develop 53 industrial units, you're going to have a really hard time getting funding with a Big Four bank. The Big Four banks, again, will really heavily vet the builder that you've engaged because they're trying to protect the risk of the builder going broke halfway through the build. And also, if you've got a builder that's done a few tilt slab industrials and all of a sudden you're trying to do a massive childcare facility, once again, does that builder have the experience in that in that category to execute on it? Building's a tough game. There's a lot of really good money to be made in developing, and it's important, right? We need it. Yeah. But there's also a lot of risks. High risk, high reward.
Again, how many years it's going to take, and then is it going to even be finished?
Exactly. And sort of, what happens, what happens before that, the overall position of the sponsor or the borrower is important. So if something comes up that's unexpected, does that borrower actually have the asset position or the financial position to cover those unexpected costs? I had someone building a $14 million childcare development, and before that, they bought the land. Before they got started, as they were doing the soil testing, they found there was asbestos in it. So they actually had to dig that asbestos up, dispose of it appropriately, and then buy more dirt to fill in the hole.
It was at their own cost.
That was at their own cost, yeah. That was in excess of about 1.2 mil. The bank said, we're not going to fund that. That doesn't add value to the property. So they needed to fund that up front. They got funding off the back of it because there was equity in the property, but that all happened after they had done all that work. So they had to have that cash to do it.
What could have prevented that for them to just assess the property really well before going in? Or because you can get the report, you can see whether there will be or not, or was it a surprise for everybody?
Yeah, no, it was I'm pretty sure that was a surprise for everybody, and that was a development that it took 2 years, over 2 years just to get to that stage. So there's a lot that can go into just holding costs. What could they have done to prevent that? Look, I don't know. This is risk management. You can get all these different things done. You can do soil tests on every spot before you do make an offer.
Be an unexpected.
And then that's a cost, right? Yeah, so you have to manage what's the cost versus what's the risk. And if the risk is unlikely, if the cost is high and the risk is unlikely, and if the risk does actually occur, it's not expensive, then you wouldn't bother. But if it's a high probability of that risk or a very high consequence of that risk, it might be worth paying those funds.
Yes. So making sure that you will be able to deliver it on time. You have enough cash flow or support that will support you for that, or someone who is actually experienced.
Yeah.
So having your right team again, like from the get-go, is very crucial when you are starting your journey in a commercial development.
And the right team will help you if you've got a bit of uncertainty in that space. The right team will help you with your risk assessment and your due diligence. And this is where like a buyer's agent might come in really handy when you're looking at places. They can help you with that assessment because they do it all the time.
That's a very good point. How is construction finance structured differently for industrial and medical developments compared to the standard commercial investments?
Sure. So if you're talking development funding for industrial versus medical, there's probably not a lot of difference in terms of how it's structured. But if you're comparing development funding to commercial property investment funding, there's a big difference.
Yep.
Commercial property investment, basically, I wouldn't say set and forget, but you might get a loan. It might have a 3 or a 5 year term. It might be interest only, but it's term debt, right? So you've got a bit of stability and, the funds go in to purchase the property and then you don't look at it again until it's time for renewal if your lender has a renewal period. Often that renewal period will be timed in the lease.
Yes.
So the banks will want to review that loan at the time that the tenant lease is up to make sure that you've got a new tenant in or the current tenant is going to exercise on their options. Development funding, on the other hand, it will be progressively drawn. So the bank will look at your feasibility. They will factor in all of the hard and soft costs, including interest, because interest is typically capitalized on those, which means the interest comes out of the loan as opposed to the borrower's pocket. And then that loan is progressively drawn. So the borrower will put their funds in first and then the loan will start to draw down. The builder will issue an invoice saying, we've done this, we want to be paid for this. The lender will say, all right, we'll send the quantity surveyor out to make sure the builder's actually claiming the correct amount. And when those line up, then the lender will pay and then that cycle will go on and on and on again.
Yes.
And, there could be, depending on the size of the development, there could be 20 different stages. There can be delays as a part of that. If it's a big resi development, they might be rolling it out in stages as well. So it's probably the progressively drawn nature of it. The lender will control the funds in development finance to help them manage the risks associated with those constructions.
So it's not too bad. So say, for example, if I had a lot of money, a lot of cash in my bank, and then I'm still a newbie and I've got a team of newbies and then I'm just going to put this money in, then it could be a very big risk because anything could happen at any point in time. But if you have got a lender that will actually give you a timeline and then show you what exactly the risks will be involved, and then you would know that beforehand in order for you to sort of like just jump in the game, basically.
The lenders are in the business of managing their risk, not your risk.
Yeah.
But in most scenarios, it's a shared risk, right? Yeah. Like if a lender's worried about something, there's probably a good chance that you should be worried about it too. Different lenders will have different appetites on different risks.
Yeah.
In your scenario where you said you've got a team of newbies and you're a newbie and nobody's done this before, but you've got a ton of cash. Yeah. Well, that statement of position, your position is going to need to be sufficient to overcome the risks that are present in the other aspects of it. We'd like to think that if you've amassed a fair bit of wealth, you've probably got a history of making some really good decisions. So you're probably already pretty good at getting the right people to advise you in the areas where you're not super experienced. So I think it's a bit of an unlikely scenario, but we're just using extremes. Yeah, we're just using extremes. Right? Yeah.
Like you can't do that. You have to assess the risk. You can't just jump in without knowing the depth of it. What level of pre-commitment or leasing do banks typically require for industrial versus medical?
Once again, whether it's in industrial or medical, a Big Four bank is probably going to want 100% debt coverage on the pre-lease or the pre-sale. Now, if we're comparing industrial to the medical, and we're talking about a pre-leasing scenario, the money coming from the lease will need to be sufficient to cover the interest from the loan by a certain ratio. So those ratios might be different. For a light industrial, a lender might want 1.35 times interest cover, whereas for the medical facility, they might want 1.5 times interest cover.
Right.
So there's more buffer in that transaction to manage the other risks associated with it. So what I mean by that interest cover ratio is if the interest expense on the debt is $100,000 a year, well, we want to make sure that the net rent from that medical facility where the ICR ratio is 1.5 times, we're going to need $150,000 worth of income to cover that. And if the lease doesn't cover that, then we're going to be looking for other sources of income to cover that, whether that be from your PAYG income after expenses or from your business or from other assets that you own.
So the ideal scenario is to have the tenants ready to go before you even
if you're looking
do
for
up a proposal.
if you're looking for a big four lender and you don't have really strong cash flow to prove that you can support that interest once the development is completed and support an ongoing vacancy period, pre-leases are important. But we're talking big four lenders there. Most of your second-tier lenders and your private funders, they won't have that requirement. Most of your second-tier funders are quite happy to take what the valuer says is market rent, and depending on the asset class, of course, they might be go, okay, yeah, cool. You know, you don't have a lease in place, but when you do lease it, you'll be able to get this much, which will meet our interest cover ratio, which will vary from bank to bank as well. So once again, I guess that's my job, right? Matching the right borrower with the right lender. You know, if you've got your pre-commitments in place and you've got the experience and we can get you with a big four lender, that's great. That's going to get you a really good rate and good terms and probably less covenants. But if you're not in that position, and you don't quite have the cash flow or you don't have the pre-commitment in place, well, then we're looking at a different kind of lender. You're going to pay a little bit more, but this is an investment asset, right?
Yes. So, again, it's all about the predictions and then and some sort of an evidence to support that. Yeah. What are the most common financing mistakes new developers make in industrial or medical projects and how that can be avoided?
What are the most common mistakes? So, in terms of like when they're dipping their feet in, I suppose understanding strategy, understanding what they're actually looking for. I don't know if I said this before, but you know, the person that's just come from a barbecue and somebody told them they should be buying a commercial property.
Or what you see in the Instagram highlight.
Yeah,
and then
exactly.
You see like, oh, let's just go for it.
I hope it wasn't my highlight. Understanding, right advice, understanding strategy, knowing the risks that are associated with commercial. I'm a massive fan of commercial. I absolutely think it's the way to go, but it does have risks that are different. It does often cost a little bit more money to get in upfront. And the thing is that just about every person has lived in a house, right? So you've got some experience with residential, which is what makes it approachable and palatable, like because you feel like you know a little bit about houses because I sleep in one every day. Whereas not everybody has operated from a commercial premises, so they might not be aware of the industry and the risks and things like that. But look, I think mistakes is making sure your financials are all sorted out, understanding what entity structure you're going to go in and why you're choosing that entity structure, understanding whether you're looking for capital growth or cash flow and what asset class you're wanting to look at, and having your team in place. Yeah,
having the clarity where you want to go and then doing your research first in order to have the right team on board before you even think of going into it.
Yes.
If a new developer wanted to be bank ready in 6 to 12 months, what steps should they take before? I think we have covered that in this question in terms of like you need to be very clear, you need to have the right team on board and things like that. But is there anything else you wanted to add?
Yeah, I think that really ties into that last question. Get your financials sorted. Most banks won't accept financials outside of 18 months old. So like right now we've just come into January. So if the most recent financials you've got prepared are FY24, well you're probably going to have to go to your accountant. So what that means is if you find a property that you want to buy and you make an offer for it, and then you go to the bank and the bank says, well, actually, we want to see this, this, and this.
Yeah.
You've kind of got a couple of choices. You might have to ask for an extension, which might not be accepted. You might miss out on that property as a result of it. Or you might have to go to another lender that's a little bit more flexible around those requirements, which means you're going to pay more interest. And then there might be exit fees. Yeah. So that's, you could be paying for your learning in those scenarios.
Very expensive learnings.
Yeah. Be prepared.
I've had many of them. In terms of like growth, risk, and scaling, when should investors consider like non-bank or private lenders instead? I think we covered that one. But how do sophisticated investors use leverage responsibly without overexposing themselves? So I think it's like, how do you prevent yourself from costing you too much or having the expensive learning?
Yeah.
What do you need to do?
I think in terms of you're trying to scale a portfolio, don't get too caught up in certain costs. So like the one that everybody looks to first and foremost is interest rate. Why do people look at the numbers? Well, because it's easy to compare.
Yeah.
But if you need to pay more to secure an investment asset that is going to make you some good money now in terms of cash flow, or it has some amazing development potential at minimal cost and really, really good uplift, don't let the rate hold you back. So just because it's not a big four bank transaction doesn't mean that it's not a good transaction. Weigh that up. You might have to pay a little bit more to get in and hold that asset, but the payoff is probably going to be worth it. And that kind of comes back to your strategy and knowing what your strategy is and knowing what you're doing. I hope that answers that question, Varsha.
I think it does.
Good.
What role does portfolio restructuring play in scaling commercial property wealth?
This is a good one. Probably has a few different answers, but if you're looking to build your portfolio and you've got X amount of cash to get in, so your first asset purchase might be something that has really good capital growth potential. And once you've secured that, a year or two down the track, and you've got that capital growth, you use the equity from that property to purchase the next one. Now your next problem is your servicing capacity. So asset number 2 might want to be a cash flow play, so something that's going to add servicing power into your borrowing portfolio, into your borrowing capacity. And then it might very well be that, okay, so that first asset that I bought, or it might be the fifth asset that that first asset you bought, you might be 5 properties in, and those capital growth assets that you purchased, they may have done their job. They may have already met that capital growth that you needed. So it might be time to cash out and put some more cash back into your portfolio to buy the next one. So I know some people like to say, buy and never sell. And that's not bad. But once again, if you've got your strategy and you know why you purchased that asset, if that asset has done its job, recycle it.
It's just time to move on.
Turn it into cash.
Yeah.
Buy another cash flow. Buy another cash flow. Actually, if you've got something that's had great capital growth, you might sell it and buy 2 smaller, great little cash flow assets.
Which is easy in terms of you're not putting too much time, effort, and energy and money into maintaining that property, because that property would have taken you because it's tired, then you are just investing a lot of money to sort of make it look good all the time and then attract the right kind of tenants in there. Whereas if you have done it to a level where it's it's perfect now, then you should just cash it and then move on to your next one, where you can obviously, as you said, just buy 2 or multiple properties from the same, where it's just turnkey sort of a thing. So you just set and forget. So you're not putting too much time in maintaining a property all the time, and there's not a billion people are calling you all the time in terms of the tenants with little issues in it. So I think that's a very good point.
Don't get caught up in the emotion of it, which is pretty easy in commercial.
It
actually.
It's easy.
Now, Varsha, you have an amazing story in terms of your BHAG, or your big, hairy, audacious goal, and your why, or your reason for doing what you do. Do you mind sharing that with us?
You put me on the spot. I think I've shared it with you and a bunch of other business owners before that. It's more on the why is starting an orphanage and building an orphanage in India. And it is still very close to me, and it's very, very big. I don't know if I will be able to do it in this lifetime or not, but like it's good to have a mission and a vision of where you want to be. But I would love to build an orphanage, and it started from when I was 16 years old. Like it was a family ritual to celebrate birthdays in an orphanage, and one of this specific birthday, my mom's birthday, and I was like 16 or 16, I think, at that time. And I picked up this girl. We shared the same name. Her elbow was broken. And as soon as I picked her up, I still exactly remember that how privileged I am to just be on the other side. And just having the parents that I have, the family that I have, the support that I have, I can never, ever forget that moment. So in terms of like, the why, that's the big why. And when I have the journey of like the hiccups in terms of like we all have challenges in business and we all feel like, why the F am I doing this? You know, at that time it's so much bigger than me that I just forget those problems, and it's just the why that keeps me bringing back to that, like why I want to do what I want to do.
It's such an amazing story, and I've heard it a couple of times now, and I never get sick of hearing it. But it's just, you know, I think that gratitude that drives you, and you know, wanting to make a difference for people less fortunate. I reckon that's just such a powerful story, and I'm so glad that you shared it.
Oh, thank you. Just even when I think about it, I'm like so privileged to even be here and be in this room having that conversation, because I never thought that I would be doing this ever. Like, so it's like, again, a dream come true sort of a thing.
It's an amazing story. Makes me miss that too. Thanks,
Thank you. Well, thank you so much, Matt.
Absolutely.
This has helped me a lot. If someone like me who wants to start their journey, what is that one thing that they can learn from this podcast and would implement it? Or what's that one advice that you'd give them to just implement it now?
Just start. Just start moving forward. Mm-hmm. There's so many different things to think about. Don't get analysis paralysis. Mm-hmm. Start talking to people. Make active, and I don't just mean talking to people at barbecues. I actually mean, you know, reach out, have a chat to your accountant, have a chat to a finance broker, have a chat to a buyer's agent, have a chat to a sales agent, and just start learning. Where you don't have the knowledge and the experience yourself, you might have to pay for it. You might have to buy that. You know, financial planners are another good one as well. But yeah, just start. To start. Yeah.
That's a very, very good advice, I think, because a lot of people get caught up in the learning, I have to be perfect. And then when I am completely knowledgeable, that's when I'll start. Well, it's good to have knowledge, but it's very crucial to take that step and then take an action. You might fall, but at least, you know, you have started, you have learned something out of it, and then the next time you can do better.
Yeah,
so
100%.
Awesome. Well, thank you so much.
Thanks, Varsha.
For being here.
Pleasure.
Thank you. If this episode gave you clarity, now is the time to execute it. Take one action, apply it, and start building your version of the financial freedom. Share it with someone if you thought this episode has added value. Like, share, and subscribe, and I'll see you in the next episode of the Commercial Wealth Podcast.